All right, quarterly review is here. The stock market's second half began where the first half ended. And I'll say that it continued its strength and continued its winning ways. The S&P 500 gained 2.24% in July, and while establishing new all-time highs throughout the month. This sustained rally reflects three key catalysts driving market optimism: corporate earnings consistently surpassing expectations, increasingly favorable international trade agreements, and a notable uptake in investor confidence. Now, the second quarter earnings reports released in July demonstrated broad-based economic strength as the month concluded. Over half of the S&P 500 companies had reported results, with an impressive 80% of those exceeding earnings per share expectations. This performance provides fundamental support to a continued market appreciation scenario. Now, technology giants led this earnings resurgence with Meta Platforms, ticker META, Microsoft, ticker MSFT, and Alphabet, ticker GOOG, delivering standout quarterly results. Now, the artificial intelligence revolution continues as a powerful secular growth driver, particularly benefiting these market-leading companies whose substantial index weightings amplify their positive impact on a broader index. While these earnings cycles demonstrate corporate America's ability to generate sustainable growth, and true test will be whether remaining companies can match this performance standard throughout the second half of earnings season and the remainder of the year. Now, July brought significant developments in international trade relations that further energized market participants. Comprehensive tariff agreements with two of America's most important trading partners, that's the European Union and Japan, represent a meaningful shift towards economic cooperation. Now, these deals extend beyond tariff reductions from the so-called announced Liberation Day to include substantial capital commitments. I mean, the European Union pledged $600 billion in direct U.S. investment, while Japan committed $550 billion to American economic development. Additionally, the European Union committed $750 billion specifically toward U.S. energy sector investments. Now, these agreements not only reduce trade friction, but also inject significant foreign capital into the domestic economy, creating a multiplier effect that should benefit multiple sectors throughout the United States. Market psychology has benefited from the self-reinforcing cycle of rising asset prices and improving investor confidence. This positive feedback loop, while creating upward momentum, powerful influence of sentiment on market dynamics. Recent economic data has provided validation for this renewed optimism, most notably the preliminary Q2 GDP reading of 3%, a full percentage point above the 2% consensus that was expected. Now, this economic acceleration is particularly impressive given the first quarter's 0.5% contraction, representing a 3.5% point improvement that has bolstered investor confidence in the economy's underlying resilience and growth trajectories. The convergence of strong corporate earnings, favorable trade, all these developments, and improving economic fundamentals has created a supportive environment for equity markets. The strong start to second quarter and earnings season and substantial international investment commitments provide near-term optimism. However, investors should remain very vigilant about the sustainability of this current momentum. While the turnaround from a contracting economy in Q1 to 3% growth in Q2 demonstrates very good resilience. Continued monitoring of earnings quality, trade policy implementation, and other economic factors will be crucial for maintaining this positive trajectory. As market participants look ahead, the foundation appears solid through prudent risk management remains essential in navigating potential volatility. That's your Q2 update.